Tuesday morning, good morning. What do you need to know this morning? Okay, first up, Samsung profits rise by 19 times. 19 times. That was great, but it wasn't great enough. A Qatari LNG carrier has been hit in the Strait of Hormuz, and the NATO summit kicks off in Turkey today. It is a key moment for the European defence sector's recent rally, Anna.
Absolutely. We'll keep an eye on all of the developments at that NATO summit, of course, Guy. Sticking to what's happening in the Asia session then, as a result of those numbers out of Samsung. Yes, great, but not good enough. And that's what's taking the Kospi down by 4.7%. The Samsung share price is weak. That weighs on the Kospi. It weighs on Japanese companies that compete with and supply Samsung and rivals to Samsung. How will that play out for European stocks? We'll watch the European futures picture. That Qatari tanker that was hit in the Strait of Hormuz, well, that is pushing up the gas price here in Europe this morning, up by 5.2%. The oil price is a little firmer, broadly unmoved, but a little firmer. We will get some perspective on the developments in the Middle East. The countdown to the opening trade starts right now.
Tuesday morning, good morning. The chips are down. Anna's just been giving you the numbers, telling you what is happening in terms of the figures we're seeing on the screens. But the underlying story is really interesting here. Samsung just posted a 19 times profit increase. That is huge. The whisper number, though, particularly from the buy side, was bigger. And as a result of which, this looks like a disappointment this morning. There has been a huge rally, though, recently in this space. And as a result of which, you have to do very, very well to keep up with that kind of exuberance. And this morning, Samsung didn't.
Yeah, absolutely, it did not. And as you've been pointing out, a 19-fold increase in quarterly profits, but that was priced. It's amazing what the market has adjusted to price in right now. And looking ahead, this is going to be interesting because it seems that analysts are looking at, yes, shortages will persist in 2027. This is memory chips. But what's the mood in 2028? What's the demand picture, the pricing outlook in 2028? That seems to be where we have questions. And to be honest, we don't have many clues in the Samsung numbers so far on that subject. We might get a bit more at the end of the month when they give us more guidance. We also don't have a sort of sectoral breakdown yet. This was just the big picture from Samsung. And the sectoral picture might tell us, yes, OK, so the memory side of the business doing well. But this is a company that also makes consumer-facing products that then have to pay more for the memory chips and all the other things that we know are highly priced as a result of the AI build-out.
It's also hard to believe that from here they can push margins much higher. Yes, you're going to get maybe in the totality of the spend a bigger number, but the margins, do they get higher from here? Is that something that we've kind of reached the limit of? Are we also reaching the limits of people's belief in the fact that we have not got more capacity still to cut? The build-out story is going to be something that we worry about. So the margins are kind of here, but as we start spending more, the margins come down. Are we starting to see the cyclicality story beginning to emerge?
Yes, we've talked a lot about whether the Chinese are going to build out more capacity. Is that going to bring down those margins? I mean, anything that any kind of parabolic-looking chart is going to attract others into the market, isn't it? And it's also going to attract politicians into your market. And we've seen already pressure on this company to provide bigger payouts to its staff. It's done that, and some of that is evident in the numbers that we're getting today. And we've also seen the political pressure to build out more capacity within South Korea, so spend more on capex. All of that very much in focus then. Let us talk about what's going on with the energy markets, because you mentioned what was happening in the Middle East with the Qatari LNG tanker being hit. That is pushing up the gas price this morning here in Europe. It's pushing up the Brent price as well, 1.2% higher, 72.86. But at the same time, as we're talking about this, we've seen Axios reporting on other Iranian firings on vessels that cross. At the same time, we're talking about gluts. Goldman Sachs, Morgan Stanley talking about a glut in the oil market. And the Saudis are reducing the price they're charging to Asian customers. And the only time they've done this in the past is when there's been a price war on. So we're getting some kind of conflicting signals, probably at different points of the curve, aren't they? But different signals about where pricing is heading right now.
It is really interesting. There's a glut at the front end of the curve. And you can see that in terms of just the shape. We've come down at the front end. Then there's a spike higher as you go out a few months. Then it comes back down again. So the market is signalling a short-term glut. It's the duration of it. Clearly, there are a lot of hydrocarbons coming out at the moment. The market is therefore expecting that it's going to be oversupplied. But how long does that last for? It's interesting listening to Isabel Schnabel talking about this at the ECB. She sees a situation which is different to what we saw before the war started, and we are going to see higher prices for energy. So, yes, we get a short-term glut, but over the medium term, we're going to be paying more, and that theoretically, year on year, should be inflation.
Absolutely. So we watch those different parts of the curve. We'll also watch who is buying oil and who is buying energy products broadly. Javier Blas out with an opinion piece talking about China not having restarted buying. We've got a lot of strategic petroleum reserves to restock, of course, but also the Chinese went into the war that took place in the Middle East with large amounts of stock, and they haven't started rebuying to replenish that. And Javier Blas says that, the price of Brent could swing between 60 and 80 based on what the Chinese do, whether they decide they want to buy and when they decide they want to buy.
So that is swing demand, not swing supply, which is an interesting kind of take on where we are right now. Let's talk about the NATO summit. Trump's going to arrive a little bit later. We're anticipating he is going to talk about the fact that NATO needs to spend more, the Europeans need to spend more. European defence stocks have rallied recently. How critical is this summit and the messaging that comes from it to that rally? I think is going to be really interesting. If we do see a commitment, if we do see a strong commitment, does that rally extend from here? Because these stocks got very overvalued, then came down pretty sharply, and now maybe pricing a more realistic scenario. But what is that scenario? Maybe we'll find out over the next couple of days.
Absolutely. And are we going to see new orders announced at this NATO summit? We've seen the Canadians already talking about what they're doing around suppliers of submarines for their navy. So Canada picking the Germans to make those, a German-Norwegian tie-up to make those. ThyssenKrupp Marine Systems, that's the preferred supplier. So we'll certainly watch that. This is Canada's largest ever military procurement. So this is the scale and the seriousness with which NATO is taking this, with which European and other non-US members are taking this, and taking the messaging that we're getting from Donald Trump on the need to step up and spend more. Germany, for example, 2027 budget, that's now being discussed, being agreed. By the end of the decade, it seems, because the budget includes some things that go out to 2030, by the end of the decade, 1/3 of the federal budget is going to be spent on defence and security, which seems like an incredibly big number and a big journey that Germany has been on over the last 5 years.
So what is interesting about that is that Germany doesn't have the interest payment story that a lot of other people do. It's interesting, if you look at the United States, interest payments on the current debt load are at or about to exceed what they spend on defence, which may be a crimping factor going forward. Talking of the fixed income story, Camilla Astabaroga is going to be joining us very shortly. She will be discussing what we are watching in the fixed income space. EFG Asset Management Senior Portfolio Manager Laura Cooper from Nuveen will be here as well. Global investment strategist Mikolaj Firlej is the Expeditions co-founder and general partner. What is Expeditions? It is a fund that has been built and has raised money recently to invest in European defence startups and scale-ups. Annabelle Lever, Sciences Po professor, joining us to talk about French politics. That's another story we need to fold in to the fixed income story as well today, as we watch a key ruling coming through for Marine Le Pen. Yes, and perhaps we'll linger on that in a moment. Let's look ahead to that and some other events that we are watching throughout the day. As we've mentioned, the NATO summit really gets into gear today. It begins in Ankara in Turkey. Then 10:30 a.m. We get the Bank of England Financial Stability Report. 12:30 p.m. the Paris Court of Appeal will give that ruling in the Marine Le Pen trial, the appeal case. And later, Allen & Company's Sun Valley Conference begins, bringing together many of the biggest names in AI, media and technology. That could, of course, create some headlines. And later, SpaceX will join the Nasdaq 100. If we linger for a moment on that story that you mentioned then, Guy, around Le Pen, the key thing is going to be what she was convicted for, embezzling public funds. It meant that she got a 5-year election ban and was supposed to spend 2 years in jail, but that was on hold whilst the appeal was being held. So anything that influences the timescales around that ban is going to be, of course, important as we head into the first round of the presidential elections, April next year. Who is likely to be more successful? So look at it from a market point of view and look at it from a business point of view. Who is likely to be more successful, Bardella or Le Pen? Or Bardella with Le Pen backing him? Would he be the more likely candidate to win? So I think at the moment, the betting odds don't actually differentiate very much. The polls don't differentiate very much between the two. But it'll be interesting to see what the policy formulation looks like between these two and their leadership of the party. Would Le Pen be less business friendly? Would she be more? Would she change more? Would Bardella be more influenceable? There's various kind of. It's beginning to get really interesting in terms of, because we've seen these two as being one and the same, but they're not. Yes, and has the fact that they seem to appeal to different demographics helped appeal to a wider audience? And if they're forced to lose one, I mean, maybe they're not forced to lose one. Maybe they can continue with two. Maybe Le Pen is able to lead. Maybe Bardella leads. And as you say, she plays some supporting role. But
whether the result of this court case changes people's view, we'll wait and see. But we'll get some further analysis, as you said earlier, and we'll be speaking to somebody from Failt with some analysis of what is at stake here. Coming up on the programme then, oil climbs after fresh tanker strikes in the Strait of Hormuz. We'll get the latest on the risks facing ships passing through the vital waterway. Plus, London's punishing summer heat prompts JP Morgan to relax some of its strict return to office rules. We will discuss that later. Up next, Samsung shares plunge despite reporting a 19-fold increase in quarterly profit. We'll break down those numbers for you. And if you want to get involved in any of these conversations, we do like to hear from our viewers. IB plus BBTV Go. That's the function on the Bloomberg terminal that puts you in touch with us. This is Bloomberg. Welcome back. 7:14 here in London, and this is the futures picture for European equity markets. We are expecting to see some weakness. Perhaps the energy complex might support London a little bit. We're only up by 1% on Brent, 72.79, but that might make the difference for the London market. Also keeping an eye on anything basic resources, gas related as well. We had an interesting statement out of Shell also about their trading business, so we'll get to that later in the programme, but all of that might set London apart, and tech will be perhaps the weak spot given what we've heard out of Samsung and what that has done to tech stocks over in Asia then, Guy.
What we've heard out of Samsung is great. The problem was, though, that expectations were even greater. So Samsung's quarterly profits, 19 times, 19-fold. That's the year-on-year push that we're seeing in terms of these early figures, these preliminary figures. Not enough, though. Not enough to impress investors. The Chipmaker shares at one point were down by as much as 10%. Masahiro Wakasugi, technology sector analyst at Bloomberg Intelligence, joins us now to give us some analysis of what we're seeing here. Look, the market clearly wanted more, particularly on the buy side. What is your view of what Samsung has told us?
Right. Yes. If we look at Samsung's operating profit, that was a really good number, beating 6% compared with the consensus. And the operating margin for the company-wide achieved 52%. And if we try to calculate the division profit, we can estimate that the semiconductor division probably achieved around 80% operating margin. And that is pretty much similar to the Micron's operating profit number, which reported about 2 weeks ago. So to some extent, it's a really good number. But for some people, it was a kind of in line with expectation. But it's a quite good number.
OK, so good, even if in line with expectation. Yes, the bar is high, it would seem. So what lies ahead for Samsung's memory business? We've asked many times on this programme whether this is really a structural story or whether it's going to end up being cyclical. But it seems that everyone wants to build into it at the moment anyway.
Yeah, basically we think that the AI demand will increase going forward. And I think that the AI training started a few years ago, and now we are shifting the demand from training to inference. So in that sense, not only DRAM or HBM, but also NAND flash memory or solid-state drive demand will increase. So NVIDIA or hyperscalers will build some data centers, and where we should need more NAND flash memory or solid-state drive. In that sense, we will see more demand coming from not only DRAM but also NAND flash memory. So I think that this demand trend will continue over the next few years. So we think basically it's a structure.
Okay, so Samsung is one of the giants in this sector. Talk about what this means for the rest of the sector. As you work your way through the supply chain, what are the implications?
Right. So of course we can expect some good result from the peer, like SK Hynix, and probably achieving a similar operating profit margin level. And in addition to that, remember that Samsung and the SK Hynix both announced a pretty huge capex over the next 5 years, and they are trying to double the capacity to keep up with the surging demand for memory. So in that sense, we can expect some more demand for the chip making equipment. Maybe in Europe, probably ASML or ASML International, they can have a bit more demand for the chip making equipment, and probably we can see more demand coming from AI for the chip materials, including silicon wafers or photoresist or photomask blanks. So we think that demand is spreading across the subsectors due to the AI demand.
Masahiro, thank you very much. Thanks for joining us. Masahiro Wakasugi from Bloomberg Intelligence with the latest on Samsung. Let us stick with the tech theme in Asia, because earnings from the world's largest memory chip maker are in the spotlight as investors consider some of the valuations around AI. To discuss the wider impact, we're joined now by Bloomberg's Anthony Stevens, who's in Hong Kong. And Anthony, I want to ask you about the Samsung numbers, the impact they're having on the Kospi, and I suppose the broader conversation about rotation and dispersion within markets. I'm not sure we're seeing the same, though, in the Asia session as we're seeing in the US. How does this report from Samsung influence your thinking?
Well, the US has a lot more tech. They have the hyperscalers, they have the big Apple component. So there's a lot more places for money to leave semiconductors and go to. So we saw that overnight, in multiple sessions, you have the stock swinging around 3 to 4%, and then the equal weighted S&P is not really moving. And now we have the VIX under 16. So the US is a much bigger, more diversified market, with the banks doing well, the industrial starting to catch a bid, while the semiconductor space is selling off. In Asia, we are much, much more heavily weighted to the semiconductor index. Between TSMC, Samsung, and Hynix, this is a giant chunk of MSCI Asia until you get to Tencent. So the weight of this Samsung result is much heavier in Asia, and the dispersion does not get to play out on the index level, but it's definitely there today in the markets. So you have Samsung quite weak, you have Kioxia quite weak in Japan, a lot of the memory names in Taiwan and China are quite weak. But on the other side of things, you have the Japan banks that are up around 2%, you have the China internet space that's up around 2 to 3%. So there is that dispersion, but at an index level, this Samsung result, where volatility and positioning have met in a very unfortunate manner, it is weighing on Asian equities as a group.
Anthony, is it Europe's time to shine?
Look, Europe has some positive signs for it. Going by the industrial rally, right? The next stage of the AI build-out, as Masahiro kind of touched on, is moving away from training these AI models to using them. And using them involves a lot more localization when it comes to the AI infrastructure build-out. Servers closer to home, server farms closer to home, and that construction, that air conditioning, that power, that industrial usage, that benefits Europe. Also, we're starting to see a bounce in the software space. Finally, people are starting to save money on tokens as they realize what they can do and what they can't do with tokens, and they're becoming more financially responsible. That's driving a big bounce in software. In China, we saw that first, but it's also happening in India, with the NSE IT index has had quite a decent bounce. And the US IGV ETF has bounced quite a bit. So US is kind of indicating to Europe how to play this. You move from the hardware side to the industrials and the software side if you want to stay in the AI trade, and if you want to leave the AI trade entirely, then stay in the banks. And of course, Europe has a very well-performing banking sector. So this stage of the market probably helps Europe at the margin.
Anthony, what do you make of a lot of guests talking to us about the momentum trade? What are you thinking about the momentum trade of late? Some suggesting that the momentum trade has basically been a shorthand for buying memory against the hyperscalers. Is that still the case, or is that going to shift? Is that going to change?
Memory's had its worst drawdown since 2023, right? And you're seeing this transfer of kind of narrative away from momentum means tech to tech means dispersion. So basically, people have to do a lot more hard work around what part of the tech trade is working. You can't just buy everything tech and see it up and continue to chase what has been going higher. So you're starting to see the best performers revert quite meaningfully. So that is the definition of momentum unwinding, right? What is what worked in the first half of the year is not working to start the second half of the year. So, but you are continuing to see what is working is still technology. It's just different parts of the technology. So that transition from momentum to dispersion is very important. The US dispersion index, where it's the only publicly trackable dispersion index, is trading at all-time highs, while VIX is close to like the bottom end of the range, below 16. So that's a very unique setup for individual stock pickers. Just to belay the point, you're seeing that in hedge fund returns. So single stock, deep tech expertise is really paying off. The hedge funds who have that expertise are at the top of the ladder. So are index rebalancing funds that trying to pick what stocks are going to index. You know, just two pods in Millennium have made $3 billion according to our reporting using the index rebalancing strategy.
Anthony, thanks very much. Bloomberg's Anthony Stevens in Hong Kong with the latest on the markets and how the Samsung numbers are filtering through. And the latest on tech then, Guy. OK,
lots to digest there. What else do you need to know this Tuesday morning? FIFA World Cup hosts, the United States of America, are out of the tournament. It was a 4-1 defeat last night to Belgium in Seattle. It was convincing. The match was, of course, overshadowed by President Trump's controversial intervention regarding the suspension of star US striker Firlej Balogun. Balogun was supposed to be suspended for the game against Belgium for a previous red card. However, FIFA allowed him to play following a phone call between President Trump and the FIFA president, Gianni Infantino. Bloomberg has learned that two Millennium management teams, or pods, focused on trading index changes, made around $3.7 billion between them in June. The gains helped Millennium post a 4.1% return in June, lifting the year-to-date performance to above the 10% level. And JP Morgan has relaxed some of the finance industry's strictest return to office requirements for its London staff after the UK capital sweltered through the recent record high temperatures. Sources say the bank concluded that the heat was serious enough to merit having staff talk through their work from home arrangements with their managers. The more flexible approach comes as Londoners have faced school closures and disruptions to public transport after temperatures reached all-time highs for June. I understand that the JP Morgan office is air-conditioned. I would have thought that would be the one place you would want to be.
Absolutely. I have memories of working from home during a lot of heat during the pandemic. We don't get to work from home very often, given the nature of our jobs, but it did happen, and it was extremely hot. And why anybody would choose during a heat wave to work from home in Europe, where we don't typically, well, in Northern Europe, where we don't typically have air conditioning, I have no idea.
So the co-host I was working with at the time, who shall remain nameless, Alex Steele, basically spent the whole time while we were doing it. She was in New York, I was in London, with her feet in a bucket of ice.
I thought she would have been taunting you with her aircon.
No, so it was too hot, so she basically had her feet in a bucket of ice.
OK, well, don't do that.
Which was how she managed to work her way through it.
It is an interesting reminder about how sectors that you wouldn't necessarily think would be hurt by hot weather or have to do anything really because of hot weather are having to think about work arrangements for their staff, aren't they? And that is perhaps one of the things I'm going to be talking about later. I'm going to be hosting a live Q&A event titled Why Europe Can't Cope with the Heat. That's at 2 o'clock UK time. Terminal clients and digital subscribers can ask questions of the Bloomberg News team about all things climate related, and there are the serious questions around excess deaths, which have been reported in Northern Europe as a result of this. But then there are other things about just how people, buildings, infrastructure, businesses and economies adapt to this, because this is these events are coming more frequently than they ever used to.
Much more pushback in Europe to air conditioning. It's noisy, it's bad for the climate, all of these kinds of factors, which are interesting in terms of the divergence we have between us and the United States. More things we need to spend money on. There are many things we need to spend money on, which is why we maybe have a bit of a debt issue. We're going to talk about all of that with Kimia Astabaroga from EFG Asset Management. She will also be talking through the implications for the fixed income trade of the recent attacks we've seen overnight in the Strait of Hormuz, stoking inflation fears once again. Energy prices are up this morning. We'll talk about that. It's next. This is Bloomberg. OK, here we go. 30 minutes to go until the start of trading here in Europe. Equity market trading Bonds are about to start trading. We'll get you the details of that in just a moment. Futures look like this at the moment. We have the FTSE and the CAC both up, but not very much. The Euro Stoxx 50 is down, but not very much. I say not very much because if you look at what's been happening overnight in Asia, the swings continue to be massive and violent. Today we are down. Leverage is also a factor in this, but we're digesting the Samsung earnings, and it has produced some wild swings, to put it mildly, once again, in the Asian session.
Yeah, absolutely. So equity markets very much focused there on the earnings story, the margin story for companies such as Samsung. Here in Europe and into the bond markets narrative, I mean, does all of that sound inflationary? Well, we have got slightly higher yields here in Europe this morning, up by around 2-3 basis points at the 10-year part of the curve. Is that to do with higher oil and gas prices or unrelated? Let's think about that. Oil and gas prices have crept higher following attacks on vessels in the Strait of Hormuz, reigniting perhaps inflation anxieties. Let's think about this from a fixed income perspective. Camilla Astaburuaga is with us, Senior Portfolio Manager at EFG Asset Management. Camilla, nice to have you with us. So we saw at the beginning of this hour, gas prices up by 5%, oil prices up by 1%. Further tensions in the Middle East, a reminder of the tensions and the way they can flare up once again in the Middle East. Does this remind us we need to continue to worry about inflation?
Yeah, I think it's a worry that the market has, and I think it makes sense. You know, I mean, all the oil that passes through the Strait of Hormuz, there's not a good plan B yet. I mean, I know that there are pipelines being built. I know that people are still replenishing their reserves, but for now we're still quite reliant on that part of the world for oil. That, of course, put pressure on inflation. And I think especially after we saw Warsh being a bit more, or the FOMC being a bit more hawkish, I do believe that the market is pricing correctly this bear flattening that we have seen in the Treasury curve in particular, where people are more worried about inflation, maybe more than labor, or that's expectations. The good thing, I would say, though, especially in the US, and then we can talk about Europe, is that you have seen this flattening. So people are saying, or investors are expecting this increase in short-term rates, but not in the long term. So that anything that the hiking cycle, I mean, that it's not going to be a proper hiking cycle, that any revision to monetary policy now in the short term will likely more be reversed in the next months.
Okay.
Or that's the expectation.
And does that make it less likely that it happens at all?
Or, yeah, exactly. They could be, you know, just fine-tuning what is the perfect balance at the moment, or they could just do it then undo it later. Exactly. So we'll see how much.
Yeah, what is your expectation around the ECB then?
Yeah, the ECB, I mean, is in a harsher situation. Of course, it's more, with all the gas and oil prices, it's even more dependent on that. So you would see the same moves, even in a bit more of a stronger, realization. But I do believe at the moment that the market is pricing it correctly. The 2-year is starting to look attractive. We've seen that in fixed income markets, a lot of the investment has gone to money markets in the past. I think it's at an all-time high, but don't quote me on that. And especially that treasuries, as part of money market, is also a big proportion, and the 44%, I think, is at the moment. So you could see that this recent move potentially could push investors or even commercial banks to a bit more duration in the 2-year part, maybe.
What message is the credit market saying about the AI trade right now?
I think this is my personal view, is that with growth potentially deteriorating, and with governments in a very tight, fiscal situation with very low flexibility, the market is reliant on the AI capex investment cycle to sustain the growth. Because if the consumer growth deteriorates and there's no government willing to invest in they don't have the capability to, increase growth, then we're relying on this. But then there's still so many uncertainties about how we'll turn this into positive returns. So there's still a lot of uncertainty, but I think that people want this to happen, because if not, there's no other, underlying growth option.
So it affects the govies market.
Yes.
It affects the credit market. It affects the credit market as well. Like at the moment, people seem very relaxed about buying AI-related debt. Maybe I'll park SpaceX to one side, and we'll talk about that maybe a little bit later. But do you think the market is being too relaxed about what it demands when it comes to the AI trade. Because I look at Samsung this morning, it's all over the place. The earnings have produced this kind of really whippy stock reaction. But at the moment, the credit market seems to be quite relaxed about kind of buying debt from the hyperscalers and everybody else to fund this AI build-out. Is it too relaxed, or do you think it's about right?
I think at the moment, with the balance sheets that are so strong and the liquidity that they have, I think that there's still, there's no moment to panic or anything. But there will be a point where if this doesn't translate into future earnings, then people will start reassessing the fundamentals. And for us, that's the main thing, and it's the only thing that we can do with all this information floating around, is to really look at the fundamentals, which story can translate into earnings, and at the end, who's able to pay down their debt. And it's as simple as that.
And how long do we have to do that, do you think? From the credit market perspective, what's the time horizon you're looking at then, Camilla? Do we have to see corporates who are using AI for inference to drive up productivity? Do we have to see evidence that that is happening in 2027? Or is 2028 okay? How long can it take with the amount of money that's being spent now on CapEx?
Yeah, exactly. It's such a good question, because you want to give them the benefit of the doubt. This doesn't happen overnight. These cycles do take time. Yeah. But at the same time, like, how much, is too much? How much is being naive versus being realistic? So, we'll see, and depending on what the surprise, if it's too negative or too different from the expectation, or if it's just, again, fine-tuning with the growth. But it's something that is really affecting everybody. And as I was saying, the last time I was here, in the end, everybody's competing for capital. AI is competing with governments, is competing with, industry and with consumers. So,
if the AI trade rolls over, is there anywhere in the fixed income space that you think acts as a hedge?
Well, I mean, to be honest, I am quite positive on credit, although I haven't seen very positive now. I do believe that the macro environment is quite positive on credit. Balance sheets are still quite, healthy, most of them. Right. Yields are very attractive. I think, like in investment grade with a mid-duration, even relatively low duration, getting 5-6%, it's not a bad level.
And that yield protects my portfolio.
Exactly.
If I lock it in
it's a cushion to protect you against either interest rate moves or spread moves. And you would expect them, sometimes they will have a positive correlation, but in the long run, they should have a negative correlation, and you would expect that to happen.
Thinking about that, we had an auction in Japan today that was at the longer end, and it had a yield that apparently brought people in. So I suppose if you get the yield right, this was the 30-year auction, strong demand because the yield was around 4%, and for some people that was enough. Yeah. Is that the kind of calculation a lot of people are making then?
I do agree with that, yes. And not only Japan, I think in most of the cases, even in Europe and with bonds and with treasuries, the real rates, especially the long end, they are looking attractive. They're better than they were before, at least.
We're watching fiscal authorities and their ability to spend on everything they need to spend on soon. I wonder if your view that everything is sort of looks well priced is going to be tested by the amount they need to spend on defence. We're going to get an update from NATO shortly. The amount they need to spend on defence, governments under pressure to return cash to their electorates in some way. Where does that end up, Camilla? How does that test the fiscal stability in Europe?
For me, that's the main risk, honestly. I mean, AI, I think that the market will adjust to, and private credit, not private credit, private companies, they will adjust easier to demand and supply, I guess. But governments, I believe that that's the main risk that we're seeing. It's just the inflexibility that they have, and it just keeps growing, their debt. And not only the debt, it's also the interest cost that is bringing as well. At some point, it's going to be for the detriment of the people. When's that point? I think we're getting there.
You think?
I think we're getting there. I think that the investors are going to start asking for more and more compensation to participate in lending them money.
Okay. On that note, we'll watch it very carefully. Camilla, thank you very much indeed. Camilla,
thanks for having me over.
Senior Portfolio Manager at EFG Asset Management. Analysts are certainly weighing in on their view when it comes to what is happening with this CapEx cycle and the AI hyperscalers' plans.
There is going to be a time, we don't know when it's going to happen yet, where the CapEx cycle will exhaust itself. And we will have, we've talked about this, that there is going to be malinvestment here. We don't think that spending cycle is over because they just started raising the capital in the credit market. So they're going to spend the capital, okay? But we can have these mini cycles in the structural bull market.
Malinvestment, that's a new one. Mike Wilson, Morgan Stanley, CIO and Chief US Equity Strategist. We're going to have more on the AI trade, the chip story, the Samsung story, all of that next. This is Bloomberg.
They committed to invest 5% of GDP in defense by 2035. And now, just 1 year later, we already see transformational progress. Here in Ankara, I expect nations to present clear, concrete and credible plans to reach that 5% goal.
The NATO Secretary-General, Mark Rutte, speaking yesterday in the run-up to the alliance's annual summit, which kicks off today in Turkey. Let's get a preview of what we can expect from this big summit. Bloomberg's chief Europe correspondent, Oliver Crook, is in Ankara. We're awaiting the arrival of President Trump. Everybody wants to know what his view is going to be, particularly on spending plans. How hard is he going to push Europe, Ollie?
Yeah, that's the big question, Guy. And I think it's really sort of interesting because this is really the follow-on from that meeting in The Hague last year, that 1 year ago when we got that spending commitment and really seen as one of President Trump's great foreign policy triumphs, one that was really sort of unmitigated. Everybody in Europe really got on board with a couple of exceptions and spending 5% of GDP on military and defense, something that U.S. presidents have really pushed for a very, very long time on the European side. And Trump really got that over the line. Over the 12 months since then, though, of course, there's been a lot of other foreign policy action from the Trump administration, a lot of it not quite as successful, and particularly the war in Iran has driven a wedge between a lot of these NATO allies and President Trump. So we're going to be watching very closely some of the bilateral relationships. You've had a very sort of public, very ostentatious row with the Prime Minister of Italy, Giorgia Meloni, which extended yesterday on Truth Social with Trump posting memes. But I think for the Europeans, it's about not rocking the boat with Trump. It's about getting more concrete and definitive plans to how you get to that 5%. And we heard it from the Secretary General of NATO, Mark Rutte, yesterday saying that we're going to get some announcements of tens of billions of dollars worth of procurement, worth of contracts. So I think for the President of the United States, they want to make it very easy for the President of the United States. They want to sort of advertise everything they've been doing here on the European side. And of course, the President himself said that really the only reason he's attending this meeting is because it is being held here in Turkey, and he's doing it as a sort of a favor of President Erdogan, somebody that he's grown very close to over the last sort of year and a half, particularly sort of putting into prominence Turkey's role in the geopolitical stage, not just in NATO, but of course diplomatically across the world, particularly with a number of these crises going on in the Middle East.
And Ollie, in terms of the European leaders' priorities, perhaps they want to put the focus back on Ukraine. Is there some chance they get the focus back on Ukraine and actually make some progress towards ending the war?
I think that is, they're certainly betting on that, and I think President Zelensky himself is also betting on that. He will be in attendance here. Of course, it'll be sort of a sideline meetings. We understand he will get a meeting with President Trump on Wednesday, and for Zelensky, I think he really senses a sort of opportunity in the air. He wants to build on some of the progress he made with President Trump a couple of weeks ago at the sidelines of the G7 meeting. I mean, of course, for Zelensky, this has been a roller coaster administration. You know, you're beginning with that terrible meeting in the Oval Office a year and a half ago where incessantly the President of the United States was repeating, "You've got no cards, you've got no cards." What Zelensky would like to portray to the president now is that he does in fact have some cards, and you've seen them really on full display. You've got that 90 billion euro loan from the Europeans that's going to Ukraine. That is going to fund the war effort. You've seen really the Ukrainians arrest a lot of the motion on the battlefield from the Russian side. The problem they've got is, of course, still on air defense, which you've seen over the last couple of days. They're basically unable to stop any of these Russian cruise missiles. So he wants to bring the Americans back in. He wants to say, listen, we are holding cards, we are doing well, we're striking deep within Russia, but we also critically need your diplomatic support, but also your military support. Whether or not he will be able to get any of that extra hardware, those key Patriot missiles is another question. Those are obviously in high demand, not just in Ukraine, not just in NATO, but of course in the Middle East as well.
Absolutely, and there are key bottlenecks that are worth talking about in that space. We'll come to that a little bit later. Ollie, thank you very much indeed. Oliver Crook, our Europe correspondent in Ankara. We'll be back at the NATO summit throughout the day. We've got a lineup of great guests that we're going to be focusing on. We've got the Swedish Prime Minister, we've got the Finnish President, amongst a whole host of names that we are going to be talking to throughout the day.
Let's get to the here and now, though, in markets. Turn our attention to markets in 3 minutes on the opening trade with Bloomberg's Asia Markets Executive Editor Paul Dobson with us now on the programme. And Paul, it's interesting when the micro becomes the macro, because they have the micro story around Samsung and their earnings. But given the scale and presence of Samsung and one or two other companies in the Korean market, this then has sort of market moving potential at a wider level. What did you make of the numbers out of Samsung and their ability to move the Kospi?
Yeah, good morning, Anna. I think that that's increasingly becoming the case, actually, that Asia's markets and Asia's companies are influencing global market dynamics, particularly those in the US tech stack. For Samsung today, what we saw was an extraordinary jump in earnings revenue, but at the same time, a market that is topping out somewhat, and so came back off those highs despite it beating analyst expectations. So I think there's a couple of things going on here. One, a rotation trade, which we've seen over the recent sessions, where people are putting their cash into other assets beyond technology, and that's seen in a couple of things. So although the Kospi got hammered today, it was still only down by a ratio of 4 companies falling to 3 companies rising. So not all-out kind of defensive play. If you look in Japan as well, for example, the Topics there, which is tech light, is outperforming the Nikkei. So some signs there of that rotation trade too, though. Samsung's earnings actually often, when it reports a profit beat, so out of the last 16 times it's reported a profit beat like today's, on 10 of those occasions it's fallen, so it's seen as something of an opportunity for investors to take some of the profits off the table too. And actually sometimes when it misses, in fact more times when it misses, it rises, so a slightly counter-intuitive indicator there.
In terms of what else we're watching this morning, the auction we saw in Japan for 30 years I thought was really interesting. Yields may be getting to the point where demand is there.
That's right, Guy. So extremely strong demand at that auction, with yields just on the brink of 4%. So that seems to be something of a level where long-term investors are more willing to look at Japanese government bonds. We did also hear from the government some more reassuring signs there. One of the ministers, called Kyuchi, was talking about the idea that no, there's no government policy to try to prevent the Bank of Japan from raising interest rates. Why does that matter? The higher they can get short-term interest rates and the faster they can, the more it sort of gives market confidence in their inflation fighting dynamics, and therefore the more it can bring down those longer term interest rates.
And let me ask you, Paul, about what's going on in China. We've seen the PBOC unveiling measures to cement Hong Kong's yuan hub status. What are expectations like there?
Yeah, so I think that this is an important sort of dynamic, not for immediate pricing, but for the very long-term view. China, again, pushing the yuan as an international currency of funding and trading. So in particular, it's expanding the offshore yuan markets in terms of how much the HKMA is able to release into the market, and it's allowing more onshore market participants to buy CNH denominated bonds. So it's all about getting more bond issuance in Hong Kong and getting more money into there to swell the market. But the US is fighting back somewhat here as well. We hear Besson talking more and more about the idea that he wants to have a strong dollar. So that tension is starting to ratchet up between the superpowers over currency controls.
Paul, great stuff. Thank you very much indeed. Always appreciate the update. Paul Dobson, Bloomberg's Asia Markets Executive Editor. Stocks to watch. Let's find out which ones we've got a focus on this morning. Chloe, here are the details there.
Good morning, Guy. Indeed, we are starting with tech stocks today that are, of course, going to be in focus after the Samsung earnings. The earnings disappointed, and of course, that is going to really matter for all of those names up here on the board, because those results from Samsung were seen as something that was really going to set the tone for this AI trade going forward, and really potentially say something about the durability, the sustainability of this AI-driven rally. So we could see that weakness in the Samsung shares translate into some weakness there for those names. It is worth noting, however, that this is more a matter of elevated expectations rather than weak fundamentals, with one analyst in particular saying that the figures were actually extraordinary, but that they were just not enough really to hit those really high investor expectations. So definitely a sector in focus this morning. We're also going to be keeping an eye on oil, which is going to be also very much a key sector to watch this morning after a ship carrying liquefied natural gas was struck in the Strait of Hormuz. This is, of course, causing some anxiety anxiety among ship owners and really testing the strength of this US-Iran deal. There is also going to be Shell in particular up here on the board in focus after a production update which signaled very strong oil and gas trading results over the second quarter. This is the first look that we're getting into the performance from big oil in this second quarter that was obviously very tumultuous in terms of energy markets. So this looks quite positive for that sector, so we'll be watching out for that. And finally, TKMS in Germany is going to be in focus as well after winning a contract to build 12 submarines for the Canadian Navy. This is a deal worth tens of billions of dollars, and this contract was very much between TKMS and the South Korean company Anwar Ocean, and we saw Anwar Ocean actually plunging on the back of losing this contract. So we could see this divergence in performance there continue this morning, and TKMS really win or really see a boost in the shares on the back of this contract win.
Chloe, thank you very much. Chloe Melly with some of those stocks to watch. And I'll add a couple of other sectors that are sort of on the radar, I guess, a little bit this week. The global beer businesses could be in focus. I mean, yesterday we actually saw that the food and beverage and tobacco sector was weighed down a little bit by Anheuser-Busch InBev, which was down by 4% in session. Heineken was down. All of this because we've seen Brazil knocked out of the World Cup. We've seen Mexico out. Now we have the US out. What does that do to sales around the World Cup?
I would have thought, yes. The English know how to drink beer. So do the Norwegians. They're still in.
There's plenty of them still.
So at some point you are going to see teams being knocked out. And there still seem to be some with drinking boots that remain.
Yes. With our thoughts on drinking things, I saw coffee prices were up by 16% yesterday. So we'll keep an eye on everything coffee related here in the European session.
For us on the morning shift, this is a serious issue that we pay a great deal of attention to. 5 minutes to go until the market opens here in Europe. Futures a little mixed this morning when it comes to the narrative. We will update you. The market is about to open. 5 minutes to go. This is Bloomberg. So the Americans came back to work yesterday, just in time for the Belgian game. Sorry about that. This is what the session looked like. This is how the session progressed. We basically went from down there to up there. There's a little bit of, therefore, positivity baked into the European futures story this morning. But you've also got to fold in what happened overnight in Asia. The Kospi was down hard. The Samsung story, the main culprit for that. But it's such a whippy space right now. It's hard really to get a handle day to day on exactly what the more medium-term trajectory is. But anyway, this is what the futures picture looks like here in Europe. A little quieter. You've got to fold in as well what's happening on the energy story, which may benefit the FTSE 100 today, up by 0.1%. Euro Stoxx 50 down by 0.2%. The DAX futures down by 0.1%. Defence stocks could be in focus. There's plenty of other things that we need to be watching out for today. Maybe it's a kind of sector single stock story kind of a session. We'll watch. Anna, what do you got?
Yes, well, I've got a few sectors and a few single stocks to talk about. So let's think about that. In terms of tech, you mentioned it, Samsung out with the numbers. It's a very demanding world, isn't it, where quarterly profits can increase 19-fold, and yet that can be entirely priced. And so as a result, we get this strong performance by Samsung, but the stock falls, the sector is weaker, and others in the space also weaker over in the Asia session. So the tech names could be in focus to the downside this morning. Shell is certainly going to be in focus. We've had an update from the oil and gas business signaling it had another strong oil and gas trading result, saying that the oil trading profits are pretty in line, but on gas trading the results were significantly higher than the first quarter. So that's going to be an area of focus for us. And as we head into the NATO summit proper, Guy, we're certainly focused on defence names. TKMS in focus, although it was hinted at yesterday because of that announcement by the Canadians around submarines.
Been a good few weeks for that business. Defence stocks, though, have rallied recently, which is interesting going into this NATO summit. OK, let's show you some numbers. Let's tell you what is happening this Tuesday morning. This is the session that we are getting. Was it the one we anticipated? Well, broadly so far, yes. The FTSE 100 is up by a little bit. We're expecting it to be up by, let's call it, circa 0.2%. We'll give it a minute. Maybe it will get there. There we go. We're kind of moving in that direction. Stock 600 down by 0.1%. Is Europe the antidote Look at that, no volatility. Is Europe the antidote to the extreme volatility, the leverage volatility that we're seeing coming out of the Asian session almost on a daily basis at the moment? CAC's up by 0.2%, IBEX is up by 0.1%, AEX, we'll see what ASML does this morning, down by 0.1%. These are not big moves, considering we're getting the kind of 4, 5, 6, 7, 8% moves on the Kospi on an almost daily basis. Maybe this is the trade you want to look for if you are looking for some respite from that. Anyway, that's the session so far. Anna, a little bit up, a little bit down. What are we seeing in sectors, and what is the single stock story?
Yeah, well, there's interesting things happening with basic resources. If we start at the bottom of the sector basket, basic resources appears to be the worst performing sector, which wasn't entirely anticipated. We haven't got huge moves on copper or on iron ore, slight moves to the downside. Just looking at what we've got on gold and on silver, and there we do see a bit more movement, perhaps. So 0.9% down on the gold price, and the silver price is down by 1.6%. So we do see some movement there. So basic resources under pressure, technology also under pressure, and that's less of a surprise given the numbers out of Samsung, the weakness in the Kospi, the weakness in some of the Japanese markets as a result of this. So Soitec is weaker, ASML Holdings, BE Semi, ST Micro, ASM International. So all of those very tech related, and all of those down by more than 2% in today's session. But that being said, the balance of sectors is to the upside. So we have more than 2/3 of sectors moving higher, I'd say. And personal consumer discretionary grocery stores, an acronym is a mouthful. But that's not doing too badly. That's up. And that is up because Carrefour is stronger, and actually a whole swathe of stocks in that space are stronger. And autos and auto parts are stronger as well. So we have, yes, the focus on the downside with technology and basic resources, but most of the sectors are in positive territory. Shell's doing well. It's adding, I think, the most points to the European market this morning on the back of the trading update that we've seen there. Some of the software names are coming back. SAP's not doing too badly. Saab is having a very good day as well. We're anticipating that maybe we get an announcement today on NATO replacing its AWACS system. So we'll see whether Saab is a beneficiary of that. So the defence names come back. So yeah, it's basically tech off, groceries on. Yes, absolutely. We're all buying a lot of groceries. Let's get a longer-term picture with Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Laura, really nice to have you with us. So I suppose if we're worried about what happens if tech stocks, I mean, I don't want to read too much into one day's worth of trade, but we've got tech stocks weaker, but the balance of things moving, the balance of sectors moving higher. So I guess in one day, you do see a demonstration of our ability to do other things other than buy tech right now. It doesn't mean that the stock 600 is higher, though, because it's down by 0.1%. So I suppose that's where I start the questions this morning, is how vulnerable are European markets if we do see the tide turn on technology, as we've seen from the Samsung earnings?
I think there's a benefit to having that European exposure in the sense that it is less vulnerable to that tech domination that we're certainly seeing come through in the U.S. But I think Europe is a very bifurcated story. So it's more of a stock selector market, because if we look at what earning expectations are for Q2, about 12% EPS growth. If you strip out the energy component of that, we're looking at about 3%. And even then, that's going to be very sector specific. So industrials, materials, and pivoting away, I would say, from kind of more of those consumer oriented stocks, healthcare. So a very kind of picky market to get that kind of concentration, non-exposure, let's say, within the US.
And so does that make Europe well positioned for the second half of the year then? If we see either a pivot away from some of the very well played tech themes or just a broadening out of the tech beneficiaries, does that play well for Europe?
I think Europe will be a key beneficiary of that. I think this broadening trend that we're seeing away from U.S. tech, I mean, I still think we're going to see tech leadership in the U.S. dominate through the end of the year. But yes, I think Europe can get more tailwinds, predominantly in the sense that the geopolitical risks are kind of easing at the margin. Europe should benefit from that. And then from a bigger term perspective, Europe is still trading at a slightly elevated historical discount relative to its history to the U.S. So maybe there are opportunities there. I think there are kind of risks still involved in having that kind of shedding of the U.S. tech exposure for Europe, but I think it's all part of a kind of that balanced portfolio from an equity perspective.
Which tech? Because the Mag 7's underperformed the gilt market so far this year.
But I think one of the reasons why we could actually see a rotation back into the hyperscalers is because valuations have come off. We're now seeing revenue growth have a slight upturn going forward. And we've seen, several weeks of consecutive outflows. So now there's positioning that's lighter in this space. And if we look heading into Q2 earnings season, this AI companies, they're going to dominate earnings once again. Thinking about the top 10 stocks in the S&P 500 are going to count for about 3/4 of the earnings growth. So I think that will bring this kind of robust earnings picture back into focus.
Aren't they spending all their money on chips, though? Isn't that the downside? Being serious, these are the companies who used to do huge buybacks and used to have kind of epic free cash that they don't anymore. So why? I look at the earnings numbers, and yes, they're spending a lot. They're getting a lot of top line, but they're having to spend a lot, and will increasingly have to spend a lot to generate it.
And I think there's two components of that. One is in terms of we'll be watching for the capex guidance going forward. And we've already seen very sharp upgrades to what their 2026 projections are.
Is that bad or good?
I think in the near term, it is markets are rewarding it as if because these hyperscalers essentially are spending defensively to kind of maintain their position in this very kind of fast-moving, innovative backdrop. So I think investors are rewarding that at this stage because last quarter of earnings, we started to see more incremental returns on this investment. I think if we start to see a pullback in that capex intentions, there's two ways markets could look at it. One is, okay, this is capital discipline. This is actually positive. I suspect, though, if it's a pullback in capex because demand is not there, I think that's when we're going to see that as a signal to the market. But I think in the near term, capex is probably going to stay relatively stable. They upgraded $100 billion last quarter. Probably less guidance this time around. It's too soon for 2027. But at this stage of the cycle, I actually think analysts may be underestimating what capex could be next year. So they're going to reward that even more.
And any signs, Laura, that credit markets are reluctant to keep funding this, or any signs of cracks at all in credit markets? I mean, we talked to a guest, I think, last week who was saying we're going to face a refinancing wall at some point because post-COVID, there were a lot of companies took the opportunity to refinance at really low rates. They haven't lasted, they haven't endured, and so that's something of a headwind that's going to come our way. I mean, if that comes at the same time as we start questioning the capex build-out, I wonder what happens.
Yeah, it's a great question. I think what's been kind of quite surprising is just how resilient investment-grade credit has been in the U.S. in particular, given spreads still remain historically tight, despite this ample issuance that's coming in. I mean, if we look at hyperscalers alone, they've doubled their share of the U.S. IG market. They now represent about 4% only over the past year. Looking at capex intentions, about $2 trillion is going to be funded by the U.S. IG market over the next few years. That's going to make a material impact in terms of hyperscaler share of investment grade. But at the same time, these are, AA rated. They're, largely have healthy balance sheets. So there's not a clear sign that these hyperscalers will be that catalyst to trigger a widening in spreads. And the overall backdrop of the U.S. economy, yes, we're seeing some slowing in the margin in payrolls, but this is still showing resilience. So that, alongside this robust appetite for all-in yields, suggests credit can probably continue to withstand some of these potential pressures coming through from issuance.
Has the easy money be made in the tech trade, though? Is it going to get harder from here? You've seen these vertical lines on so many charts. Does it? If I'm just trying to balancing risk from here, yes, maybe the train stays on the tracks, but is it going to get harder to do that? And therefore, in terms of the risk-adjusted story around my portfolio, do I want to be thinking about how I mitigate some of that?
I think we're going to see greater bouts of indigestion in these markets as they do try to absorb kind of what the actual returns on investment could be from some of these tech companies. So yes, I think the easy trade has probably come through. Now we're going to see much greater dispersion in the space, and that's going to require much more discernment around who are the companies that can actually generate the returns on a lot of this AI spend. I mean, if we take a step back and think about some of these companies, what we're looking at is very similar to infrastructure cycles that we've seen previously, in the sense that we have this very early overconsumption, then we have kind of this digestion period, and then a reacceleration. And I think we're already starting to see some companies in that digestion phase where they're kind of looking at tightening the usage, shifting to cheaper models, And then kind of, I think over time, though, we will start to see reacceleration. So all this to say there's going to be kind of bumps in the road in terms of this tech trade.
Well, and we thought, and you were talking about indigestion in markets around some of these things, and we thought we might get one of those bouts of indigestion around SpaceX, that, this was such a big, they're coming to raise such a lot of money in different markets, notably the equity market, but also in corporate credit as well, and that might cause some indigestion. How would the market absorb that? It didn't blink, it seems.
Well, and it does seem to be these mega IPOs. I mean, the challenge is that the value creation has really been done in the private space. So it's very different than what we've seen previously in IPOs. And I think that's what was raising these concerns, given what valuations are coming in. But the free float is very different from the broader market cap. And I think that's why we did see some absorption going forward, I think going forward, though, I think it'll be critical to watch for this is really a gauge for kind of broader risk sentiment. And I think that just suggests that this buy the dip mentality, this FOMO still is prevalent in these markets.
Laura, nice to see you. Thanks for stopping by to see us. We always appreciate it. Laura Cooper, Global Investment Strategist and Head of Macro Credit, joining us from Nuveen. Core 6, let's take a quick look at what we are watching this morning when it comes to the European equity trade. Defence names are in focus, but it's interesting to see Rheinmetall dipping as we see other names like Saab going up, maybe becoming a little bit more kind of focused. TKMS is an interesting name to also watch out for this morning. ASML, look at that, that's a big drop. So when you see ASML down by 4%, you know that European kind of the stock 600 is going to be having a little bit of weight to the downside. That's the narrative we're watching. Let's talk more about where we're seeing that tech trade widen out to. Close here with the details of that.
Good morning, Guy. Indeed, as expected, we are seeing this AI-related tech trade very much in the red this morning with, as you mentioned, ASML down quite significantly and Sweatec as well over in Paris down more than 7% this morning. That is the read across from those Samsung earnings that really disappointed. This was seen as results that were going to really confirm that the AI trade was really is still strong, or potentially something that would have made perhaps raised some concerns around the durability of this AI rally, and it seems that it worried more than reassured investors, and so we are seeing that translated into some weakness over the entirety of that tech sector, including in Europe this morning. It's a very different story for Shell, which is in the green this morning here in London, about 2% after flagging very strong oil and gas trading results, in particular very strong gas trading results over the second quarter. This is the first big oil company to report that production update for the second quarter. And it seems to indicate that the sector has been really profiting off of that market turmoil, that market turbulence that we have seen over the course of those last 3 months. And so we're up quite strongly there. TKMS is also in the green this morning after winning this contract to build up to 12 submarines for the Canadian Navy. This is a deal worth tens of billions of dollars. Of course, this is going to be something that is very beneficial for the company. And so we're up almost 2% this morning. Saab, another defense name, is also in the green because of a new buy rating from Morgan Stanley. Of course, this defense sector as a whole is going to be really in focus as we go through with this NATO summit. So all eyes are very much on that industry as well. And finally, Beauty Tech here in London, which is a company that, as the name suggests, makes beauty technology products like laser therapies, LED lights, etc., has upgraded both revenue and profit guidance. And so we're up very strongly on the back of that this morning, about 8% for Beauty Tech.
Chloe, thank you. Chloe with a rundown there, Chloe Melly, of the stocks that we are watching this morning that are on the move. Now, coming up on the programme, shares in the world's biggest memory maker slump, despite profits soaring. We will dig into why investors are disappointed with the Samsung earnings story next. This is Bloomberg. Welcome back to the opening trade. 17 minutes into a session that looks to be going nowhere at the overall market level. So a fraction of a tenth of a percent to the upside, which isn't much. But we do see some dispersion around that. So the DAX is down by 0.2%. The FTSE 100 up by 0.3%. Despite the moves lower in basic resource stocks, we have the balance of things moving in a positive direction for the London market. Shell being one of the contributors to that, no doubt. So the technology theme is weaker, Guy, but elsewhere we're pretty flat.
What I think is really interesting here is that you've got 431 stocks in the stock 600 that are up this morning. So 431 up, 157 are down. The problem is that the downside is where the weight is. So you've got ASML knocking 1.3, 1.4% off, points off the index. Siemens Energy is locking a whole load over. So yeah, Shell, SAP, Novo, Unilever, they're all up, but they're just not adding enough points on the upside. And I think that's the really interesting story. So basically, this is a European session that has been heavily influenced by what is coming out of Asia and what the Samsung news looks like. This isn't really our story today. It's an Asian story that is really having a big impact. And you can see the kinds of names that are being impacted. When you have ASML down by 4.5%, you are going to see some serious weight to the downside here in Europe. Soitec's down by 10%, Infineon's down by 4%, ASMI is down by 4%. These are heavyweight stocks that are down by big numbers, and you don't need to see many of them because even here in Europe, the concentration is relatively high. So what do we know this morning? What do we not know? What do we need to know? Let's try and answer some of those questions. Bloomberg intelligence analyst Matt Bloxham joining us around the table to talk us through this. So this isn't our session in so many ways. No. This is Samsung's impact on Europe.
Yeah, no, I think that's right. There's nothing fundamental out there on ASML or any of the other companies that are down today in Europe. So it's very much just a sympathetic sell-off, I think.
Unsympathetic.
Yeah, maybe yeah. That's one way of looking at it. I've tried to be more positive, but yeah.
Well, I mean, I don't know if this helps us be more positive, but what was so disappointing then about the Samsung numbers? A 19-fold increase in profits. You would think that would impress somebody, but not enough.
You would think, but I guess, this has been kind of fairly well flagged. We've seen this big ramp up in memory demand, pricing increasing. If you look at consensus from their sales for Q2, I checked earlier, it's kind of up about 22% over the last 3 months. So the market was largely anticipating this growth, and the numbers came in pretty much where people expect them to. And also, these are only preliminary numbers, so you don't get any of the detailed breakdown. And really what analysts are looking for is particularly the revenue split between the big segments. I think there's a sense that, yes, the memory segment, which is powered by the AI demand, is doing really well, but there may be some kind of chinks in the armour of their kind of their devices business, where that's being hurt by the same effect that's helping.
Because then they have to pay more for their memory, don't they? But then you'd think that would have more positive read across to the more strictly memory plays. And actually, it seems to be taking down the tech sector, even the ones that don't make phones.
Yeah, you would think, it's summer, it's hot, we're all suffering a bit from hay fever. I think, really, all these stocks have gone up a huge amount this year so far. At some point, there isn't that next leg of momentum. So, wow, things are even better than we thought. I think the short answer is things are pretty much where we'd expect them to be based on everything we've had over the last month or two.
How much more margin can Samsung squeeze out of this now? Because I think that's got to be the critical question. We've come up an awfully long way. Margins are super high. Do they go up and stay up? Do they go up and come down? What does the shape of the curve look like here?
So, I mean, if you look at what the market's expecting, if you go into the terminal and run MODL on Samsung, you get a great view of this. And so margins are roughly around 50%. The market expects them to be around that level for 2026, but then move higher next year to about 53, 54%. But then that is essentially the peak, and they start to come down quite quickly from there. So by 2029, you're back in the kind of high 40s. So we're not very far. Yeah, we're not very far away from the peak, according to the market, and it will come down again. We were talking about this before. There's a huge amount of incremental supply coming on. That's going to kind of adjust the balance between pricing and demand. And so you're inevitably going to get a bit of a sell-off. That huge investment is going to start to dilute your returns at some point.
Matt, remind us where we've got to on the SpaceX story and the sort of bringing it into the fold story, because I think today it goes onto the NASDAQ, doesn't it? And there was a lot of divided opinion about how quickly it should be allowed to go on to various indices. Where have we got to on that?
Yeah, so the old rules on the NASDAQ, where you had to wait 3 months, and they changed that to 15 days, and they also changed a few other things, which conveniently helped the SpaceX story. For example, they kind of took away the 10% minimum free float. SpaceX is a 5%, and they also kind of added a multiplier effect to I think it was sub 20% free float businesses. So today you will get a bit of a bump. I think from the calculations I've seen, it's only around a kind of a 1% weighting in the NASDAQ, maybe less. So it's not going to be much, but it's going to be something. So you will clearly see some technical demand for SpaceX on the back of this. Most funds would have been anticipating this and probably reflected that in their kind of original book of demand for the IPO. But I think you're going to start. This is the start of a kind of a multi-stage process. process because there's a lot of SpaceX employees with stock that they will want to sell at some point in the coming months, and that will increase the free float, and that will lead to incremental technical demand. So for the near term, that helps. It's underpinning, but really, this is a business that has to be about fundamentals, and so I think people will really be focusing on a few things in July. We'll probably have the next Starship launch. That's going to be really important, and then obviously their Q2 results sometime in August, which will help as well.
Okay, lots to watch on that front then. Thank you very much, Matt. Thanks for the analysis. Bloomberg Intelligence analyst Matt Bloxham. Let's pivot to the energy markets. A Qatari LNG carrier has been hit by a projectile near the Omani coast as it exited the Strait of Hormuz. Oil and gas prices have risen following the attack. For more, let's speak to Stephen Stapczynski, Bloomberg's Asia Energy team leader. Stephen, what do we know then about this latest attack? There's this LNG tanker. I know there were other reports of attacks, perhaps from other media outlets. So what do we know so far?
Axios reported that there have been at least two missiles sent and struck at least two vessels. Bloomberg was able to confirm that one of them was an LNG ship, 2009 build, owned by Qatar's shipping arm. It had loaded LNG earlier this month at the Ras Laffan export facility and was exiting the Persian Gulf through the Strait of Hormuz on the Omani route when it was struck by a projectile. This has already resulted in some impact on LNG flows, liquefied natural gas flows through Hormuz. There was one ship that was also laden from Qatar that was in the Persian Gulf on its way to Pakistan. It was heading towards Hormuz and it turned around and sort of pausing in place, doing some circles at the moment. But clearly there's still some ship owners that will show caution now going through. And it raises questions as to the safety on the Omani route, which is what the U.S. Has urged ship owners and vessels to go through. It's supposed to be protected by the U.S. Navy as well. But these fresh attacks do bring into question the ability of the U.S. forces to do that.
We've got front-month crude in the Gulf lower than a few months out. That's the shape of the curve we're looking at the moment. And now we find out that Saudi Arabia is cutting the price for its crude to Asia. What is the signal we're getting here, Stephen? Is it short-term glut, more medium-term demand starts to balance? What are you looking at?
I think you have to look at how the market kind of differentiates between oil and LNG or natural gas. So for oil, there are alternative routes to get out of the Persian Gulf. There's the East-West pipeline for Saudi Arabia. ADNOC has been quite successful with their shipping, their sort of service to get some LNG, or sorry, to get some oil shipments to Fujairah, reloading it and getting it to Asian customers. And you've also seen a lot of super tankers going through the Iranian route as well. So all of this oil is kind of hitting the market when Asian buyers had already found alternatives. The Asian customers, whether you're talking about Japan or even India, they had been planning for a long-haul Hormuz closure. And so now suddenly the oil barrels hitting the market does create, in a way, a bit of a glut in the sense that these customers don't really need it. So there is a fight for market share. That's why you're seeing Saudi Arabia really reduce their prices to kind of capture market, get customers, potentially from other rival suppliers, and find placement. Now, LNG, on the other hand, while oil prices have come down to pre-war levels, LNG and gas prices are still 70% higher than pre-war levels, and that just illustrates that LNG is more constrained. There are fewer alternative routes. There are no alternative pipelines. When Qatar needs to send out its LNG, they can only do through the Strait of Hormuz.
Stephen, great to catch up. Stephen Stapczynski joining us on what we're seeing in terms of the energy trade. We're going to switch to the defence trade next and get a sense of where we go with the NATO summit about to start. This is Bloomberg.
Welcome back. This is the opening trade Tuesday morning, 30 minutes into Tuesday's session. And at the overall level, just up by 0.1%. But there's a lot of dispersion in these markets around different geographies, different sectors, different themes. In terms of the geographies, you can see that the CAC 40 is doing pretty well this morning, up by 0.7%. Not so much the DAX, down 0.1%. And we actually see some weakness coming through in basic resources and technology, maybe technology partly to explain the DAX move. But elsewhere, Guy, other parts, most of the other sectors are in positive territory actually today. today. So it is very much that technology and basic resource themes that is weighing on these markets.
The tech trade is the real story here this morning. So just in terms of the balance, you're just getting an understanding of just how unbalanced you could argue this market is. So 440 stocks are up, 152 are down. Yet the stock 600 is absolutely flat. And that tells you about the weight impact that we're seeing in that lower bit, 150 down. But that's where the weight is. Volume's a little light. So you are seeing some gains. Yeah, you're getting some gains out there. Saab's having a good day today. Not only does it look as if its globalized system is going to replace AWACS, but it's also got a nice upgrade coming through. So Saab's having a pretty solid session. Shell's having a pretty solid session. Now, Shell is a heavyweight stock. It's doing well today on the back of the earnings upgrade, the trading update, and it's up by 2.5%. Saab's up by nearly 6%. Carrefour in the grocery space up by nearly 4%. Yet these aren't enough to outweigh what we're seeing at the bottom end of the market, which is where the tech trade is hitting hard this morning on the back of the trade that we're seeing coming out of Asia. ASML is down by 4%, circa 4%. That is a huge weight on the stock 600. Infineon, the big German chip stock, down by 4% as well. It is weighing. Soitec is down by 11.5% this morning, folks. It is a big weight on this market. So these stocks, just these three stocks are just adding so much weight on the downside that they're almost kind of offsetting the whole of the rest of the market. And that is the narrative you're seeing. You've got some great gains in single stocks at the top end this morning, but the tech trade is still big enough that it outweighs what we're seeing at the top of the market, Anna.
Yeah, absolutely. And so let's get to the source of that tech weakness, shall we, with an update on Samsung, where quarterly profits surged 19-fold but still failed to impress investors. The company's shares slid more than 10% in Seoul, leading to a plunge in the benchmark Kospi that triggered a brief circuit breaker suspension. An LNG carrier was struck by an Iranian missile near the Omani coast as it exited the Strait of Hormuz. The Qatari-owned vessel appeared to be travelling without its transponders turned on. That's according to ship tracking data. It's the latest attack since the US and Iran signed a peace deal in late June. Traffic through the waterway has since been resuming with some interruptions. And the NATO summit starts today in the Turkish capital city of Ankara. European members are expected to unveil billions in new arms contracts on the sidelines of the event in an attempt to show US President Donald Trump that they are delivering on defense spending pledges. Guy.
OK, let's turn back to that defence story and talk about what we are seeing in terms of the European rearmament story. European venture capital firm Expeditions has closed a nearly €200 million fund backed by leading European defence companies and institutions. It's going to invest basically in early stage defence tech and autonomous warfare. The raise comes as European nations, of course, look to rapidly scale their military capabilities at a reasonable price tag amid this shifting US commitment that we are seeing to NATO, and a huge shift that we've learnt in terms of the Ukraine conflicts on the battlefield as well. Mikolaj Firlej is the co-founder and general partner at Expeditions. Mikolaj, is this fund big enough?
Hello, Tom. It's a pleasure to be on Bloomberg Live. Yes, in short, this is the fund size that makes it perfect to capture the early stage opportunities in European defense and security. We have the possibility to invest as early as possible in the pre-seed seed stage. And then we have also capacity to do follow-on investments up to 20 million euros. So I think it is a reasonable size for the scale of the opportunity we are going after.
Where is the opportunity? What do you think Europe now needs to focus on? Where should the investment be spent?
The biggest opportunities are in two different spectrum of deterrence. Deterrence by denial, where you have to build air defense systems and deny the adversity coming into your territory. So all sorts of different air defense systems, platforms that allow you to defend, build a stronger resilience, supply chain, and so forth. And then the second spectrum is the deterrence by punishment. So you can project the power outside your territory, for instance, by having deep strike capacity.
Good morning, Mikolaj. You talk, and many in the defence sector talk about Europe needing to strengthen its defence sovereignty. How do you balance that with the other messaging we're getting from countries such as Canada, talking about smaller countries, mid-sized countries maybe coming together and cooperating on these kinds of things? How much room is there for European defence tech then to cooperate with other countries such as Canada and others?
I think this is a great opportunity, particularly with Canada. We see that we have shared interest with Canada. Both Europe and Canada are trying to offset some of the major dependencies we have on the US. So we see it as evidenced by the spending and increased collaboration. Both regions increased defense spending substantially by over 20% per annum. And both regions actually started to collaborate with each other on real projects. Canada is now part of the safe financing in Europe, so security for action. And I expect more companies from Canada to collaborate with European companies and vice versa. In fact, we have recently invested in a Canadian neoprime in defense. So that is signaling that we think about European interest from the wider global perspective.
And thinking about the role that the newer defence tech plays versus the more traditional defence plays, Mikolaj, how much of a pivot are you expecting to see when you think about the addressable market for the companies that you support? How much of a rotation from traditional technology to newer technologies would you expect to see? Because we will be probably covering both in the days ahead at the NATO conference.
I think there will be a massive shift. It's already evidenced by numerous defense tech companies that have already started to partner with established defense businesses. And also they are getting direct contracts with MODs. So I think this shift is underway. I think we can see the shift that occurred in the United States, where some of the neoprimes like Anduril over time became prime contractors, and the incumbents like Lockheed Martin became subcontractors to some of the programs of record. I think we will have similar trend in Europe relatively soon.
Okay. In terms of where you think the biggest gaps are in Europe that technology companies can deal with, obviously communications have proved to be a big part of the battlefield in Ukraine. Starlink in particular is one that stands out. Can Europe deliver what it needs if it doesn't have something that is European and capable of delivering effectively what Starlink allows in terms of military communication, interoperability, targeting, all of the other stuff that we've learnt is critical on the battlefield in Ukraine?
I think this is one of the many dependencies that we have in Europe on the US. And one of the perhaps most of the critical ones, the access to space ISR. But there is much more, I can tell you. We run the internal research at Expeditions. We interviewed numerous policymakers and users from various European countries and identified over 10 critical capability gaps. And to address these capability gaps in Europe, we have to think in decades. It won't be a short fix. Some of the things we can build relatively fast, and we should focus on both of them that we can build fast, but also the ones that can secure European sovereignty over the long period of time.
Mikolaj, thank you very much for joining us. Mikolaj Firlej, the co-founder and general partner over at Expeditions.
OK, coming up, we're going to turn to French politics. Big day in French politics. An appeals court set to decide on Marine Le Pen's embezzlement case. We're going to watch that very carefully later on. We're going to give you a preview of what you need to know about this. Annabelle Lever, professor at Sciences Po, who joins us from Paris shortly, will do just that for us. It's coming up. This is Bloomberg.
Welcome back to the opening trade, and that opening trade has us up by 0.1% here on European equity markets. So a slight move to the upside, but some real dispersion around these various sectors. Technology, basic resources, industrial goods and services are three sectors to the downside. Everything else then, Guy, moves higher.
So we are basically flat on the Stoxx 600 this morning. European stocks, there's a little bit of dispersion at an index level, but there's some really interesting things happening, I think. ASML is down by 1.12 points. The tech sector is adding some significant weight here. So that's what's happening in the markets. Let's talk about the politics. We need to figure out what is going to happen today in a key French court, which is going to announce the verdict of an appeal that has been launched by Marine Le Pen to an embezzlement case that, remember, we dealt with earlier, that effectively removed her from French politics and from running for the French presidency. And we have an election vote coming up next year, the 2027 election. So this is really key in terms of, A, French politics, and B, what's going to happen with the OATs, the French bond market. Caroline Conan is at the French Court of Appeal in Paris. What should we be looking for here? How critical is this going to be?
This is a very crucial day in the political life of Marine Le Pen, because she's going to know whether she can run for president next year or not. In just a few hours from now, she will walk in this court just behind me, the Court of Appeal in central Paris, where she will find out whether she's convicted again in this embezzlement case, and also how long is the sentence, because this is the key thing. She may be found guilty in this case about embezzling EU Parliament funds, but depending on how long she is banned from running for office, she might be able to run or not. Last year, during the first trial in 2025, she was convicted to a 5-year ban, which would have prevented her, of course, from running next year. But if this ban is brought back to 2 years, then obviously she would have already served 2 years by the end of March of 2027, which is very tight, because technically she needs to register as a candidate 6 weeks before the first round, which at the moment is planned for April 18, 2027. But technically, she could potentially make it. There is, of course, an in-between scenario where she is forced to wear an electronic bracelet and she has a suspended sentence. In that case, she already said that she doesn't want to run if she is forced to wear an electronic bracelet, because this will make it very difficult to hold rallies and to go across the country to campaign. So in just a few hours from now, the judge will start reading the verdict at 1:30 p.m. French time. That's 12:30 UK time. This could last for a couple of hours until we find out whether she is banned for 5 years or for 2 years, or whether her sentence is totally overturned, which would be a big surprise. And in that case, she may actually leave the place for Jordan Bardella, her heir, to be the candidate for next year's presidential elections.
Caroline, thank you. Bloomberg's Caroline Conan in Paris, setting up the next conversation for us. Let's bring in Annabelle Lever, who is a professor at Sciences Po and joins us now. Professor Lever, good to have you on the programme. Do you have a base case expectation for whether this 5-year ban on participating in politics or standing for public office, whether it stands, whether it's reduced to 2 years? Because that would seem to be the important matter with regards to the election next year.
Yes, I don't know. I mean, it's very hard to predict what the court's going to do. But presumably one of the difficulties with lowering the ban too much is that other people are in prison already who were not head of the party, and they've been in prison for 2 years. So it's going to be, I think, very difficult for them to not differentiate her position as head of the party from theirs.
And what role would you expect her to play if the penalty she faces is not reduced? Then, Annabelle, what role would you expect her to play, perhaps in support of Bardella?
Well, she's been very clear so far that she would keep running and promoting her ideas. It would be very strange, I think, to suppose that someone who set up the party, who made it really a mainstream political party now, who managed to appeal to women in ways that her father never did. She really broadened the appeal of the party, would just give up and go home. On the contrary, there's some sort of suggestion, there were sort of unfortunate talks of her treating Bardella as, as her tutor, or she would be tutoring him. That was then corrected. But clearly she's going to remain a large influence in the party for a long time.
Is the party more electable with Bardella at the helm and Le Pen supporting him, or with Le Pen at the helm and Bardella supporting her?
It's very difficult, I think, because you don't know who the other candidates are. And so, we as voters, by and large, we make our decisions in part on the range of alternatives, unless we're already terribly convinced about one party or another. On the side of those who are convinced Le Pen supporters, Bardella may be very appealing, but on the other hand, he's extremely young. He's only 30. And I think in particular for women who've been supporting Le Pen, his position may be difficult. He's far less keen to keep the age of retirement low than she was. She's been very clear that retirement, in her view, should be at 60 or 62, depending on when you start. But he's been suggesting that really there should be no legal age of retirement. Instead, what should count is length of service. And of course, that's a catastrophe for people who have intermittent careers, like many women. They stop various points to look after others, or of course, for those who are unemployed. So the appeal of Bardella, I think, now is coming into focus a bit more than it did before, where he, by and large, didn't say very much. And it may be that actually in significant ways, he's no longer going to seem the blank slate that he once did.
In the past, there's been the cordon sanitaire, this kind of idea that other parties will band together to prevent the right from getting in. How strong is that force now?
Well, we saw recently it's already partially split the Republican Party, because there are Republicans like Ciotti who are quite happy to ally with the Rassemblement National. And we've seen also, I think, in the Parliament that there have been people willing to vote along with Le Pen in order to condemn movements from the Macron party. So it doesn't seem to me we're really talking a cordon sanitaire like before, certainly not in the era of Jacques Chirac. On the other hand, I think there are lots of people who really still can't imagine biting the bullet and voting for Le Pen.
OK, so the cordon sanitaire is perhaps evolving, Annabelle. Do we make the assumption that somebody from the National Rally, whether it is Bardella or Le Pen, makes it into the second round? And who would we think they would face in the second round? I guess that is, to your point about we don't know who they're up against, that is the big question.
Yeah, my problem with the polls at the moment is, all these polls sort of give you ideas about, people would vote for Bardella or Le Pen or whatever. And they put them against various people who are supposed to be competing. But on the other hand, we don't know very much about whether they are competing. We don't know about what's happening between now and then. So a lot of these polls, to me, feel very fictitious at some level, because if you ask me how I would vote when I don't know what the options really are, or what the situation is and demands, I'd find it very hard to answer. And I have fairly partisan loyalties. So, I wonder with people who, for the most part, may be much less partisan than I, how they manage to do it. When it comes to who the alternatives are, I think the big thing at the moment is what's going to happen with Philippe, who was prime minister during COVID, rather successful prime minister during COVID, but it seemed, and now has major legal problems in Le Havre. So he might have been an important candidate for the centre, perhaps competing with Attal. Now it looks like he may be out of the running completely, which would probably leave Attal, who's young, who was prime minister briefly under Macron, but who, should we say, has less of the gravitas and perhaps less of the general appeal that sorry, my brain's rotting, that the former mayor, the mayor of Le Havre has.
Okay, we'll watch all of those candidates very carefully, and we'll watch this decision a little bit later on very carefully as well. We're also keeping a sort of a weather eye on what is happening in Syria today, where Emmanuel Macron, the French president, is, and we're monitoring events there. It seems there's been some explosions close to where potentially he is staying. We'll keep an eye on that story as well. Annabelle Lever, Professor at Sciences Po, thank you very much indeed. What does the market make of all of this? Let's bring in Skylar Montgomery-Koenig from our MLive team. How carefully do you think OATs are going to be watching, the bond market's going to be watching what happens today?
I mean, I'm not sure the decision today is really the key factor, but what's been interesting is in the last month or so, we've had a widening in the bond OAT spread. So we're back to the wides that we saw kind of at its peak in 2024 and 2025. And it doesn't really feel like much has changed from a fundamental perspective. So if you look at budget balance forecasts for 2026 and 27, they've not really changed in the past month. If anything, you'd say that commodity prices coming down, that means a better growth inflation trade-off, a more dovish ECB, so that should be supportive. So I think it's really just that we have more political headlines around France in terms of this decision, in terms of the announcement of when we'll actually get that election. And so if we move past this decision and whether or not Le Pen is able to stand for election, I don't think that is a huge differentiator because polls show that the far right is in the lead regardless of who the candidate is. But it means we can go into a quiet summer and kind of put that to the background. France will go on holiday and maybe you can get some tightening back before considering the real ramifications with the budget not expected till October.
Yeah, certainly a story we will keep hitting and hitting as we go into, well, yes, October and then into next year. Skylar, the Bank of England has a financial stability report coming. Is that going to be of interest to gilt traders?
Absolutely. So there are two things I'm watching. The first is with reference to banks. So there could be an easing of leverage ratio requirements. That would essentially mean that banks could buy more gilts, and that's the structural support for the market. And something we've seen since the GFC is essentially banks own less and less of a share of the gilt market or bonds markets more generally. So then coming back in would be positive. I think on the other side, though, what we're watching for, too, is the marginal buyer in bond markets has been hedge funds as a result. And they've added liquidity to the market. But the issue is when things go wrong, they go very wrong because they leave the market very quickly, and especially when it's leveraged. So there's also a risk today that the Bank of England announces some kind of requirements around leverage or limits on leverage for hedge funds. That means that liquidity isn't as strong and potentially hedge funds start to look at other bond markets globally rather than gilts.
Samsung's having quite an effect today.
Yeah.
Europe is a price taker when it comes to this. Samsung moves around a lot. Europe's getting bashed by this. There aren't many single stocks that are down today, but they're heavyweights.
Yeah, I mean, this is what's really interesting is that because you have such a high concentration and markets that are relatively small in terms of like the global sphere. Yes, I think it's the 7th largest market in the world, yeah. Korea. But two stocks make up 50% of the index or something like that. And so you have poor earnings, and that feeds through not only to the market itself, but to other markets globally. And it's made worse by the fact that it's very leveraged. So you're now having ETFs that are 2 times leveraged or whatever it is. Yeah. That influences spot prices because if the stock rises on the day, then that means that that index or ETF needs to buy more of it, which then feeds into spot prices. And it creates this very bad cycle that just means it's a more volatile index as it gets more concentrated.
It's interesting, isn't it, that people talk about Europe not having much tech exposure, and yet it can be the tech sector that is very much setting the pace. Most sectors in positive territory, but tech is one of those that's negative, and that is causing the stock 600 to be pretty flat today. So there we are. We do have some tech stocks. Skylar, thank you very much. Skylar Montgomery-Koenig from our Markets Live team. We will be back at the NATO summit throughout the day, speaking to guests including the EU's Kaja Kallas and the Finnish President, Alexander Stubb.
That is it. We are done with this show. You're not done.
Yes.
Anna will be taking you through the pulse over the next hour. Some great guests lined up there. European markets going nowhere in a hurry, but tech is under pressure. Hope you enjoyed the show. See you again tomorrow. This is Bloomberg.